Hi everyone, I'm Kyle Bechet, and this is the AAF Exchange, a podcast from the American Action Forum, where experts provide clear, data-driven insights into today's economic and domestic policy issues. Welcome, and thank you for tuning in. What's going on with your Steelers? I mean, did we ever expect them to be 3-0?
I think they have a very good chance of being both 4-0 and 4-13. That's what it looks like right now.
I mean, that's got to be.
They can win next week.
The Vikings might be my two biggest surprises of the season. And it goes to show how good of a head coach both of those guys are.
Yeah, no, I mean, I think the defense is playing lights out. But we've seen this before.
Watt is an animal.
He is unbelievably good.
Yeah.
But you know how this goes. People get hurt. They have everybody on the defense right now. This defense was just as good last year, and then everyone got hurt, and by the end of the season, we had no linebackers, and it was over. Yeah. So we'll see how the season goes.
Yeah, injuries always.
It would be very, very useful. I'll just say that if the defense didn't play every game all the time, and the offense held the ball for a while and let them rest. Just saying. It's a suggestion.
For me, I'm just looking for a few more weeks to get me to hockey and basketball season because the Red Sox got eliminated last night and there's no hope for the Patriots. Yeah. So, anyways, we should probably do what people.
I think the Patriots probably pretty competitive in college ball. I mean, not Division I.
Yeah, like we're talking FCS here, not BCS.
Yeah, I mean, they can line up with North Dakota State any day.
All right. Well, on that note, let's talk about what people actually came here, and I'll do the intro. On this episode of the AAF Exchange, the Fed's rate cut, the presidential candidates' economically wacky proposals, and Congress's looming lame duck session. Joining us to discuss all of this is AAF President Douglas Holz-Eakin. Doug, thanks for joining us.
My pleasure. Thank you.
Before we get into everything, what's been on your mind recently?
I got muzzled. I was supposed to testify today. In the House Oversight Committee subcommittee on health and financial services, and the topic was the Part D program. Many people have heard about the so-called negotiation regime in Part D that came with the Inflation Reduction Act, and the first 10 drugs have been negotiated, and they announced the prices, and we've done some work on that really, I think, comes to a pretty simple bottom line, which is the original vision of Part D was private sector negotiation between insurance plans and manufacturers. Yep. That goes on now. And then there's this additional business where the government steps in and threatens them with, big excise tax and stuff. The former got a lot more savings than the latter.
Yeah. And
that's either because they're better negotiators or they've negotiated essentially all there is to get, and there's not much left. We don't know because one of the unfortunate features of the IRA is there's no transparency. So that's the part everyone knows about. The other parts are actually just as important. They redesigned the benefit so that seniors would have a cap on their out-of-pocket. That's a good thing. That's how insurance should work. But they also took the taxpayer off the hook for the very expensive drugs in the catastrophic region. Taxpayers used to pick up 85% of that, and they put that on the plans and the manufacturers so that they have incentives to have drugs that don't cost as much and they don't take as many. And that reflects the change in the program, just so people know this is not just arbitrary. When the drug benefit passed, probably the biggest thing was to make sure people could stay on their statins. They weren't expensive drugs. Now seniors take a lot more very expensive oncology and other drugs, and the benefit has to just be modernized to reflect that. So they did all that, but one of the things that happens is if you make the plans pick up a lot more of the costs, they have to get the money from somewhere. So it was a foregone conclusion that premiums had to go up sharply. And I don't know where the people who drafted this bill were heads were. I don't know where CMS's heads were, but somehow they woke up in August and said, oh my God, they're going to raise premiums dramatically right before the election.
Yeah.
And suddenly we got a CMS premium stabilization demo, which is fancy language where we're going to just toss money at Part D plans, say, please keep your premiums down, here's some cash. I find it all quite appalling. The whole point was to make the plans have a lot of pressure to negotiate even lower drug prices, sharpen the original incentives. They undercut those incentives. They let them off the hook. It goes for 3 years. What do you think will happen in 3 years?
Yeah, same. Yeah.
So, I'm upset, which is my job in this segment. not just because of what they did in the IRA, some of which I think had a lot of merit, but the fact that I didn't get to whine about it to the Congress. I mean, come on, guys, give me a break.
They wouldn't give you the platform. So, I mean, but what would have been a better way to go about doing some of these things?
You want the same end game.
Yeah.
You want to just phase it in so that the changes aren't so abrupt that they scare people.
Yeah.
And I do think seniors might have been quite scared.
Yeah.
For a while now, Part D's been, from the seniors end, pretty straightforward deal. Sign up for the same plan every year. Formula is the same. Premiums have been the same. They've been pretty flat. So now all of a sudden, all those things are likely to change. Premiums go up. When you're trying to control the drug costs, you change the formulary.
Yeah.
Some of the plans probably wouldn't have made it, so some go away, and now you got to get a new plan. I think seniors would have thought, what is going on here? And that kind of change has to be managed and should be done with a little bit of, hey, this is coming, and then some, it's going to take 2 years, and then you'll know where you are. None of that was built in.
Yeah, interesting. Well, on that, let's turn the corner and talk about
the economy. Now I can stop whining.
I don't think so. Something tells me. Anyways, last week, as largely expected in some, the Fed cut rates, what was kind of unexpected was they cut by 50 basis points. What's your take on that?
So I think by the time they did it, it was not unexpected.
Yeah.
I, in fact, was at a conference and was asked point blank, and I said, I think they will do 50, and I think they should do 25. So they did enough foreshadowing and leaking and setting the stage that I think even markets had priced 60% chance of the bigger cut. So they did that. Remember, the mantra at the Fed has been, we can become less restrictive when we are confident that inflation will return to the 2% target and remain there. And they're cutting, so they must be confident that that's going to happen. That's stated, and now we're going to have to check. I at least look at the actual data, and maybe I'm not as confident, but we're at 2.5% inflation when you get right down to it. It has tapered somewhat in the past 3 months, but certainly not over the past 6, 9, or a year. So how confident are you in just that small sample? I'd have gone 25, held the option of going bigger later, and you could.
Yeah.
So I'm a little confused by that. And especially, given that the stated reason to ease is they had to support the labor market, which Powell described as in need of it, and there's no evidence of that whatsoever. I mean, we got claims again this morning, down modestly from last week. I mean, there's been no indication of layoffs in the economy. There's been slowing hiring, no question. ADP reports say in the small business sector, especially the past 2 months, have been negative. But, we're not falling off a cliff.
Yeah.
So in those circumstances, I think moderation should be the...
Yeah. So, I mean, they have 2 more meetings left this year. Do we...
They could cut...
We could see another cut. We could see probably stabilization.
The market's pricing 250 basis points of cuts between now and the end of next year. I think that will end up being disappointing.
Yeah.
Like, that's not going to happen.
Seems like a lot.
That seems like a lot. But,
yeah.
But they can cut more. There's no question. They're not going to stop at
I don't know if he
4
came out.
3/4.
I don't know if he came out and said it, but I remember one of the lines that stood out in my mind from Powell's speech last week was that the era of free money is over. Essentially,
Good.
like we're not going back to free money.
I'm so tired of listening to the CNBC. I mean, I'm a great whiner. I'm like one of the world's great middle distance whiners. Natural ability and training will do that. But like the people on CNBC who want free money are even worse.
Yeah. Interesting. Well, tomorrow we'll get, I guess, our first read since, this on where inflation is. But this is also kind of, we're still looking back before the Fed cut rates.
Yeah, these data were...
so this is the PCE index. Tomorrow we'll get the PCE index. What will we learn?
It's the PCE index for August. The meeting was September. The Fed's internal ability to forecast the PCE, given everything else, is pretty high. So they knew this number with a lot of certainty when they made the decision. So I would expect us to get something right on expectations. So if you're looking at the core is the best predictor of the future top line inflation. The core is going to come in at 2.7% year over year, which was up from 2.6. But the last 3 months are going to drop from 1.7 to 1.6. And I think they're focusing on that recent performance.
Yeah, interesting. All right. Well, on that note, let's move on to another favorite topic where I bet you might do some of that whining you've been alluding to. So we'll move on to the presidential campaigns and some of the questionable proposals coming out of each campaign. Let's start with former President Trump. What are three or so that have caught your attention, and give us your take?
Well, let's just take the Trump handout tour of tax proposals where no tax on tips, and then no tax on Social Security, no tax on overtime, tossed in somewhere a cap on interest rates, on credit cards, and now he's going to have tax breaks for foreign firms to live in the U.S., cut the corporate rate to 15%. He's reiterated that. The beginning of that list, I think, is indefensible. No tax on tips, no tax on Social Security, no tax on overtime. Different kinds of income shouldn't be treated differently to the extent possible. Tax people on their income, treat all the components equally, don't distort market decisions. This violates all of that.
Yeah.
And it's not a comprehensive growth strategy, which is really what we need. Now, the corporate rate is a completely different animal. I am one who believes deeply that the cut from 35 to 21 made an enormous amount of difference for the U.S. economy. I don't see an enormous urgency to go to 15, but it would be beneficial. The question is sort of what comes along with that. I certainly don't see why you would cut the rate to 15 and then whack the economy with what looked to be $3 trillion in tariffs at a 10% rate. If he goes to the 20% across the board tariff, I don't know what that'll score out at. It doesn't. The real problem is it's incoherent. There's no internal consistency. What the U.S. needs is a tax reform that gets rates as low as possible, broadens the base as much as possible, focuses on taxing consumption more than saving investment and innovation. And this doesn't fit into that at all.
Mm-hmm. On the other hand, let's do the same for Harris. I mean, from an economics perspective, what has she proposed that has caught your attention, either good or bad?
I can't name anything that I consider particularly good. Mm-hmm. Her claim is that she's going to lower costs. That's the primary claim. So she says, well, for example, we're going to give people $25,000 for first-time home buyers. Well, that's just going to raise the price of homes, not lower it. So there's a difference between the price or the cost of something and then what you have to pay out of pocket because they're getting a ton of taxpayer dollars. She's a big fan of the latter, but that doesn't solve any real problems. It just creates a big spending program. So she's got some of those. I mean, she's still talking about paid leave, child care for everybody, huge child tax credit. These aren't genuine cost reductions. Mm-hmm. These are just big transfer programs. Then they're not pro-growth. Like they exacerbate. Both these folks exacerbate our budget problems tremendously. Yeah. She gave a major address yesterday. I mean, that was advertised as a seminal address. Little historic footnote. It was in Pittsburgh at Carnegie Mellon on exactly the same stage where in 2008 John McCain gave his most important economic address. One that I personally will never get over. The PTSD is quite strong. But, same setting. And I thought it was really underwhelming. I mean, just incredibly. The new thing in there was this idea of some tax incentives, tax credits, it turns out, that would be cleverly deployed to important things, whether it's AI or advanced manufacturing or something. And also, somehow we're going to bring the steel business back to Pittsburgh and save the unions. So these are really magical credits. These are fantastic. But the staffs of the campaign said it's going to be $100 billion over 10 years. It's a $25 trillion economy. They aren't, they're going to get a couple of bicycles and a lawnmower. I mean, again, it's this rifle shot that says, okay, we really believe in growth. Here, we're going to give these investment incentives. No, you don't, right? Growth is not a proposal. Growth is a philosophy. It's a philosophy that says that at every juncture, you tailor policy to not interfere as much as possible, allow the economy to grow, and do less of other things, whether it's regulation or transfers or whatever it might be. Neither of these are pro-growth philosophers. Mm-hmm. That's not how they're built.
You started saying a little bit of it about, raising just adding to the debt, adding to the deficit. So, there's been a lot of criticisms for both these presidential campaigns of the lack of policy specifics.
Yep.
If you were moderating a debate, what policy proposals or lack thereof would you press on them?
What exactly would you propose in legislation to address the sunset of the 2017 tax provisions? What exactly?
Yeah.
How much additional deficits will you allow? Mm-hmm. What rates do you want? What would you add? What would you take out? Give me that.
Yeah.
I mean, there's a real long list of pressing issues. Social Security desperately needs to be reformed and avoid the bank, the sort of trust fund exhaustion in 10 years. Medicare Part A is going to have the same problem. It should be addressed. But just give me that one. That's the looming one. Mm-hmm. And they're silent on both the substance of what the legislation would look like and the implications. They just say things like, well, we don't want people under $400,000 paying more taxes. Well, I don't either. But how do you do that and make everything else add up? Like they don't acknowledge the trade-offs. To do that costs you somewhere else. What do you want? Where does it give?
I mean, yeah, because the next Congress has to deal with this.
Yes.
I mean, you and former Congressman Brady have written at least one or two op-eds now about this and the looming and how to go about thinking about it. And it would be good.
I'd like to know how they're thinking about it.
If they let us know how they're thinking about it, because it is something that's going to come up. And like you said in the beginning,
is failure an option?
The moving the rates down saved a lot of businesses from leaving.
Yeah.
So, I mean, it would be nice if we had a conversation about that.
Yes, I think that. And, my belief is that, the better way to do this would actually be to do it in regular order. Like, not to have it done in reconciliation on a party line vote, because that just makes it a political football. We'd like a durable tax reform that both parties have signed off on. And that's, to me, the one that people ought to be thinking about, because I think the probability of mixed government is quite high. Yeah. And so something has to happen, likely in the context of both Democrats and Republicans having to weigh in on the bill. What does that look like?
Yeah, I mean, but the other issue that I'm surprised we don't hear more about, because we're coming up on it, and it's a little bit further out, but it's the debt stuff. I mean, it seems like neither candidate really has made a whisper on it. I mean, it's not.
That's just a softball.
I know. I searched up here.
I searched the transcript of their debate, and the word debt does not appear.
Yeah.
Not once. So, the debt ceiling comes back January 1st. Yeah. On that day, it will reset to the amount of debt outstanding, which means that on January 2nd, we will be over the debt limit unless Treasury begins the extraordinary measures, which they will. Yeah. But how much conversation have you heard about that?
Yeah. Not a peep.
Right.
I mean, and I think AEI put out a study that 2034, which is not too far off, is when we'll get to a period where debt to GDP is unsustainable. So again, it would be nice if we were having this conversation. It's not the most
look, I
glamorous topic.
I talk about this all the time in front of a variety of groups, and all I do is depress them. And so it's not the most uplifting talk. I get that, but interest just passed $1 trillion in a fiscal year for the first time. We're not to September 30th yet. It's bigger than the Pentagon. Like, this now matters enormously.
Well, on that uplifting note, let's do the trivia.
Well, it's not that to talk about the Patriots. I think the debt's a slightly more optimistic topic.
We have a quarterback. The debt doesn't. All right, trivia. Under the best case scenario for a permanently expanded child tax credit and a 10% increase in the corporate tax rate, investment would fall by X percent.
8%.
Yeah, it's a little lower, 1.2%. But still.
That's the long run number?
Yeah.
Okay.
The long run number.
No, this is the study that we put out, Jordan and I. There's been a lot of talk about expanded child credits. J.D. Vance floated it on the Republican side. Had a couple in the Senate. Rubio, Romney. Democrats have pushed this pretty hard. There's a non-economic component to it, sort of pro-family policy stuff like that. But there's also an economic component that gets pushed pretty heavily. That this is an investment in the future labor force, this investment will produce better educational outcomes, higher skills, greater productivity. It's very important to do that. And so that's been pushed very hard. People seem quite comfortable raising the corporate rate. You hear lots of proposals. Harris says, let's raise it to 28%.
Yeah.
I've heard that from other people. So we just ran the horse race. Said, okay, suppose you want to have this big child credit, costs $1.4 trillion over 10. You have to raise the corporate rate 10 percentage points to pay for it. And it turns out that in the short run, the only good news in the economy is that consumption's a little bit higher because you're handing people a lot of cash and they spend it. We've seen that movie. Over the long run, everything goes negative. After-tax wages go south, investment goes south, GDP goes south. It's not a good trade. And so the benefits of those child credits are overstated in most discussions, in my view.
Mm-hmm. That was a really good research paper, and hopefully people go take a look at that when this issue comes back up. It's right on the front page of our website.
If we're doing something in regular order, we know that's part of the conversation. So some, people would want the bill to contain those components and then other stuff.
Right.
Well, if that's the core components, call me disappointed.
Yeah. Well, interesting. All right. Well, one final topic today. Congress is set to vote on a continuing resolution to fund the government through the election.
They did it.
They did
last night.
They voted on it. So government funded through the election at this point.
To December 20th, to my surprise.
December 20th.
I had forecast the 13th. They always go to the Friday before Christmas. This time they just went straight to the Friday before Christmas.
Straight to the 20th. All right.
Yeah.
So it gives them a little bit more time.
Yes.
So, anyways, that's setting up a lame duck session regardless.
Yes.
Beyond extending government funding, what other issues might come up?
Well, I think the threshold issue is, will it extend government funding in another CR, or will they tie it all up with an omnibus appropriations bill? That's going to be a political decision based on the outcome of the election. And, I think it could go either way at this point. The same is true of some things that I think they should do, right? So debt ceiling, as we mentioned earlier, is coming up. January 1st is a really unattractive date for it to go live because no one will be sworn in, and we could very well be staffing up new administrations. So, I think it wouldn't be crazy for Congress to say, okay, let's just kick the suspension another 90 days and deal with this after we're all in our seats and know our assignments. That could be on the table. They have done temporary extensions of farm bills. They have done some things on other programs. They need to come back and do those. We have the traditional NDAA, the Defense Authorization Act. That hasn't been done yet. So there's a whole list of things that they got to get to. And so the lame duck will have some things they have to do. Mm-hmm. There's always peak lame duck optimism right about now.
Yep.
Right, late September, early October, and then as the election happens and it's bitterly contested and the aftermath, people are too tired to think. They probably do just what they need to. So they'll list that theirs about what they need to do.
Or they've lost and don't come back.
Right? But the survivors get to.
I mean, yeah, because I remember, I think it maybe was 2 years ago when Manchin and Tillis and etc. were talking about doing all this stuff in the lame duck.
Sure.
So you get this laundry list of things. Oh, we'll get it done in the lame duck. We'll get it done in the lame duck, and
then they don't.
And then they don't. So it'll be interesting to see how that plays out and what we get. I imagine they'll have enough on their plates to just get, like you said, the debt ceiling done. Can't expire on January 1st. That's an unattractive time.
Really is.
And making sure that you fund the government and you're not closed through Christmas.
That's unthinkable. I think what's more likely is they end up just doing another CR to like March.
Yeah.
And that's
again, but that all depends on what the election outcome is.
Very much.
We looking at divided government? What administration are we looking at, and all that?
Yeah. So. I can spin lots of fairy tales, but let's just say there's a task list. Someone's gonna have to do it.
You're right. All right. Well, Doug, thanks for joining us on episode 154. So
outstanding.
Closing in on 200, maybe next year.
Well, I mean, what's your favorite number?
Oh, we passed that a long time
171,
ago.
171, I think, be great.
171.
I'm looking forward to 171.
All right. We can. I think we can get there by next year. Doug, thanks for joining us.
You bet.
I hope you enjoyed this conversation. Tune back in for our next episode, where our experts will provide clear, data-driven insights into today's economic and domestic issues. I'd also encourage you to check out any of the links in our show notes, and also follow us on social media to learn more about AAF. Don't forget to subscribe on iTunes, Spotify, or Google Play.